Welcome to Wise Beyond Bitcoin, your home for education, analysis, and crypto opportunities. My name is Ryan.
And my name is Lucas.
And welcome to a new year, 2022. 1st of January. We have a bunch of cool stuff in store for you this year. And we check out some of our videos. We just did one recently on Bitsong airdrop for Cosmos and Juno. And some other cool stuff. Osmosis. We got some secret info and all kinds of cool things happening on that network and the IBC in general. But today we're going to talk about the Federal Reserve, and we're going to go through this article about Thomas Hoenig, who was a ex-chair on the FOMC, Federal Open Market Committee, and he's had some cool things to say over his years in that role. Kind of an outsider, a bit of a contrarian, and some of his predictions and concerns that were ignored a decade ago are starting to become obviously starting to become in vogue and being discussed, and are better understood. That he kind of had his eye on what was coming, and his concerns and his fears were well founded. So we're going to jump into that and see, kind of take a look at the macro money side of the market, and see what that means for potentially for crypto and for the dollar, and things going forward.
And with that being said, before we move forward, this is not financial advice. This is just our research. It's educational. It's entertainment information. We're just sharing our perspective and our research. We do love, from our background in economics and monetary theory, we will continue to make it a point to share about traditional markets and what's going on with the Fed and with modern banking system and its relation to crypto. So if you like this kind of stuff, of course, we will continue to talk about the airdrops and DeFi and LPs and the opportunities that are emerging in blockchain. But we're going to be very consistent with also staying abreast of what's going on in traditional finance with the Fed, with the markets, and how they relate, how they correlate, and how they interact with the emerging blockchain disruptive technology. With that being said, I guess this is our official of the new year, our with your research, Ryan, our official deep dive into what's going on with the dollar, what's going on in the banking system, because obviously if the whole banking system goes through a major recession, depression, then the crypto markets are going to fall.
Right. Yeah, there's a big correlation here, a positive correlation. And that's something most people don't always think about. Intuition is often that crypto is kind of like a contrarian play. So if the markets are correcting and the dollar is strengthening, and stock markets falling, assets are falling, then crypto should be rallying, right? That because it's like a safe haven, right? In fact, it's going to trade or track the mainstream markets and go up and down with them. So, and that's what we've seen, and that's what theory, it kind of predicts would happen. So our intuition on that is not always correct. And we'll touch on some of that. But first, let's talk about this man and his concerns and what he talked about in this around 2010, and what's coming and what is coming out of that, and how he was correct. So this is Thomas Hoenig. He was a president of a regional bank and the Fed at the Kansas City branch. He was on the FOMC, which is the Federal Open Market Committee. This is the group who vote to either raise interest rates or lower interest rates, or to they vote on monetary policy. They decide monetary policy, and at a very high level. So it's interest rate decisions, monetary expansion or contraction decisions, which assets to buy or which to sell, and kind of the outlook about inflation and unemployment. All these things get put into their framework, and they spit out a policy answer. And he was a big part of this. Mm-hmm. And so let's talk about it. The story pretty much starts in around the 2008 era, when the housing bubble popped and we entered into what's called the Great Recession, right? And during this period, there was some bailouts. We bailed out Fannie and Freddie. Well, not we, but the government bailed out Fannie and Freddie. They bailed out AIG.
Countrywide.
And Countrywide, yeah. And then there was a collapse of Bear Stearns. They weren't bailed out. So, and that That was widely seen as being kind of a mistake, because those losses at Bear Stearns rippled out and caused a cascading effect across the financial markets, and they kind of put AIG in jeopardy, and that's what led to that bailout and other companies as well. Because counterparty risk means that these companies hold each other's assets and debts on their books. And so when one fails and then all these debts are written off, then that it can ripple out, and everybody who's holding those debts are going to be affected. So it becomes like this big perfect storm kind of situation. Mm-hmm. And in that period, the Fed printed a bunch of money to kind of get in front of that, right? To bail out these institutions and to prevent serious deflationary recession or depression from spiraling out of control. And that's a big part of it. But then after that process, there was in about 2010, Bernanke decides that they are going to go a little deeper and do what's called quantitative easing. And the idea was that the bailouts and the low interest rates weren't enough, and that we're going to have to start holding interest rates much lower for much longer than what was planned. And this is where Hoenig starts to voice his concerns and say, "Hey, wait a minute, okay?" And let's rewind and talk about why. Why would he say that? And this is generally because he had a great front row seat to the 1970s. He started his career, and this is where we're getting in the article here. He started his career in the 70s. He was a bank examiner, and he worked at the Fed. And he saw at that time that the 60s and the era of easy money that the Fed had, with low interest rates and making borrowing cheap and easy and increasing the supply of money, that this actually fueled the inflation of the late 70s. And so this easy monetary policy was the fuel for the inflation that later really drugged the 70s, almost created like a lost decade. And how was that solved? Well, inflation shot up in the 70s, and then by 81, Paul Volcker at the head of the Fed, decides that they're going to have to raise interest rates almost to double digits and it took 2 or 3 years, and we went through a big recession. And that snapped people out of this inflation expectations mindset, where they thought that the dollar was always going to be worth less and less and less, and that assets were keep going up and up and up. So it broke that expectation, and then that led to a kind of like a normalization of policy. But it took pain. The key here is that it was not done pain. There's no painless way out. There's going to be pain. Here's the quote: "There is no painless solution. It's going to be difficult, and the longer you wait, the more painful it will end up being." And the 70s is a perfect example of that. They waited too long to start reducing the supply of money, waited too long to start raising interest rates. And by the time the great inflation really took off in the 70s, it was going to require double-digit increases in interest rates in order to snap that out. And that became very painful. So this was his formative experience. Go ahead.
I like how you brought up what happened in the 1970s, because we were, in economics, you study these things and how certain monetary policies created the situations. And here we are in 2022, and we're going to be faced with similar things. And many people aren't going to understand why. Why do we have shortages? Why are there long lines in these stores? How come this? And what we're saying is we've seen this before. 1970s was characterized by long lines at gas stations.
Right.
There were price hikes at grocery stores.
Very similar to what's happening right now.
Right.
And here's an interesting part. This is one of our first main points comes in. So what Hoenig realized is that not only does easy money, those policies we talked about earlier of expanding the money supply and lowering interest rates, not only does this easy money policies lead to inflation in the price of consumer goods like bread and cars, it also drives up asset prices, stocks, bonds, real estate, the financial assets that are traded in the markets. So this was something that he separated. He separated the asset bubble from consumer price inflation, and kind of thought of these as two different things. And they are. And when you look at the CPI and how inflation rates are calculated, you'll see they are clearly two different things, because the CPI does not include asset prices. It includes a lot of other things. And it also excludes volatile asset or volatile inputs like food and housing. But so it's very narrow measure of inflation, looking at the consumer side of things, right? And he realizes that that's a very incomplete picture, because as these easy money policies take hold and as this money circulates, often price inflation of the consumer goods lags. So you can see CPI being stable or under what the target is, right? Meanwhile, you look at the stock market and you're seeing just year over year, record highs. So,
And the real estate market.
There's this in the real estate stocks. Yeah. So there's this big, not big, but there's somewhat of a separation between those two different sides of the economy. And it's important. It's good to think of them as different, because they don't all move at the same time. So that's something to think about, separating asset bubbles from price inflation in general. So the next, we're moving on through this. This is a good thing to talk about here. So there's this reflexive sort of relationship between that happens in asset bubbles. What happens is that it becomes, interest rates are low, so it becomes cheap to take on debt. People buy more land or they buy more assets, right? And as they do this, the demand for these assets goes up and the prices increase, right? So the intuition is, okay, prices go up, so that will cool demand, right? Because that's the equilibrium that you would imagine in economics is, price goes up and so demand would reduce and then price would fall because of reduced demand. So it's like the self equilibrating process. But in an asset bubble, the logic actually is reversed, because what happens is the rising prices entice more people to borrow money and to buy more of that asset. And as they do this, the asset goes up because demand is increasing. And then that increases even more borrowing and more, because people think, oh, this is just going to go up and up and up. I want to get in on it, and so the expectation is that's just going to continue, right? And as that happens, you get this self-reflexive loop you get stuck in, where instead of it correcting and going to normalizing it, you can just have asset prices just climb, and you get crazy levels like we have today, where stocks are trading at many multiples higher than what they did traditionally, giving like earnings per share and these sort of revenue metrics that people look at. So that's something to think about, this reflexivity that happens in asset bubbles, in the way that they can destabilize just based on their own internal logic and not necessarily become something that settles itself or solves itself. Right. So that's something to think about. You could even see
that going on in the if you look at the crypto blockchain market as another.
Oh, sure. That's huge.
You see this having the same exact pattern.
Yep.
That same reflexivity, that same self-fulfilling.
And it works in both ways. So it works going down too. Like, so if you have an asset and you see the price falling, you will sell it. You tend to sell it because you think, okay, yeah, I want to get out of that. It's going to fall. And other people see the price going down because you sold, so they sell too. And you get this kind of like this circle the drain kind of reflexive thing where prices just go down. That's the deflation spiral. And it's because of it's fearing for that kind of consequence is why central bankers inject so much money and do bailouts and do QE and do all these programs, because they're trying to fight that they don't want to get caught up in that loop, because we know that can almost destroy society. That can undermine social cooperation. I mean, that's, if you go back to the 30s and the Great Depression, FDR has written, there's lots of writing about how the New Deal and all these big programs that he created were a way of, in his mind, a way of kind of redistributing wealth in order to kind of placate a group of people who he worried would actually literally want to just overthrow the government. That we'd have like this Bolshevik revolution or the communism or socialism.
Hoenig talks about it in the beginning of this article, and he mentions that
he goes into that too. At the end,
wreak havoc on the
we're gonna come full circle here in a minute on that.
and I would also say that as we can see, this happens with world economies and national economies. The crypto blockchain market, as an aside, is an emerging market, but it's a baby. And we'll do another video later that compares the size of traditional financial markets to blockchain, stable coins, and crypto. But when you recognize how small it is, for those who watch our channel because they follow our crypto blockchain updates, just be aware that being so small, when the world at large decides to have a major rate hike and reset, then the amount of leverage that's in the crypto markets is 90%, 80% drops is to be expected.
Oh, for sure.
is easy to see because these markets are highly leveraged already, the markets in traditional finance, and the crypto markets are kind of fueled at the moment, fueled on people looking for places to put this easy money that's coming right now, looking for safe refuge against inflation. But when the chickens come home to roost, and if there is a time when asset prices around at large are collapsing and resetting, then you'll find that I would say that I don't know long term for the tech and the potential of growth is there, hodl, and that's what we look for, these macro displacements. But in the short run, I don't know that there is a safe haven
No, because
asset class.
everything's tied together and correlated, right?
Absolutely, absolutely. I mean, other than having some chickens and knowing how to grow and having some fresh water and
Yeah,
having
right.
a strong, it still
Some
benefits to
land,
have family and friends and a strong community. You know, it's not
right. That's the safe haven.
centralized to the max is not. But anyway, so yes.
Now, there's always going to be counter arguments to these inflation arguments about the Fed and monetary policy being the problem. And one of the main counter arguments that Hoenig came against was the idea that inflation was not purely a monetary factor, but that there were forces outside the Fed that were pushing prices higher. The idea of cost push inflation. This is the idea that oil or the other costs of production could drive inflation.
But that's kind of what, not a red herring, but that's a little disingenuous, because in economics it's like no duh. I mean, when you look at the price of anything, it's the different prices of the costs of the inputs are going to affect. There is no static value of a good or a service. It's always changing. So to see the prices of labor or the prices of inputs going up being a cause of the.
But those are prices too. That's kind of the point, is that
I understand, but I'm saying that's what I'm saying. Looking at it from money printing as a source of inflation versus just prices going up are just two different ways of looking at inflation. It's taking the definition of inflation and changing it in one breath, because in one breath you're looking at how much money is being printed.
Yeah.
And another breath you're saying, oh, but look, these prices are being pushed up by, but there are many things that can push up prices.
Sure.
Printing money is one of those things,
right?
But there are other things that can push up prices. So,
oh, for sure, changes in demand and things. But the argument here that cost push inflation makes any sense, I think that's falls for a real clear reason. Costs are prices. This is treating costs as something separate outside of the monetary framework. We're saying it's almost like a real factor. Like you got monetary factors, and then you have real factors. And this is an argument that money is not the main one, and that real factors through costs are pushing inflation higher. But here's the problem with that. Costs, like the price of oil, are affected by monetary changes. Wages are as well. All inputs have a price. They're not, the cost is not there's nothing different than a price. Cost is just what the price you have to pay to get the thing. Right. So really, you should just forget cost and just look at price. And if you say that prices are pushing inflation higher, it's circular reasoning. That's what, because inflation going higher is what we're talking about, or prices going higher is the point. So this is a Marshall's scissors thing, and I don't think Marshall's scissors holds, because the inputs that he's talking about, that supply side, that cost side, as being part of the scissors, those are prices. Those are money prices established in markets, people bidding up those assets because they wanted to transform them into consumer goods. So it's all backwards looking from the consumer, right? So even costs are prices determined in markets that are rooted in consumer choice. So costs are just prices of a different sort, right? And if that's the case, this notion that we should model costs as being a causal factor in inflation just is, I think, circular reasoning. But that's a whole other topic to get into for a different video.
That's a good point. Makes sense. I dig it.
Now, this is something I want to talk about here. We're going to leave the 70s. And well, we talked about the 70s pretty well. So let's talk a little bit about more current stuff, because this is really when Hoenig comes into his own and becomes like a name in the financial media and the news that people recognized. And because if you were following the Fed in these periods, he was one of the only names that would be coming out again in a vote note, a consistent a consistent no vote on the FOMC. So it's really during this period where he starts to kind of distinguish himself from his peers and become like a contrarian. And so let's get into that. So during this period, 2010, Bernanke shifts gears and starts to focus on extended interest rates, zero level interest rates. So basically, you're saying we're extending easy money policy even further and even more into the future. And this is when he started to become a little, well, skeptical. He thought that there was deeper dangers that were not being considered, and that the gains, that the benefit of this policy was muted. And we're going to get into that in a minute. But before we do, I want to get into this, because this is really what we started this whole video to talk about, because this is the real meat and potatoes to this story. So you can think some of the criticisms that Hoenig had of these policies were bound up in inflation, right? Asset price inflation, consumer price inflation, but that was only one part of the story. Another part of the story was the allocative effect of these policies, how it redistributed wealth inside the economy from one group to another. And he saw this, and the reason he was thinking in these terms is because he saw this in the 70s. He saw that the Fed's policies led to Wall Street speculation into asset price speculation, and if you know anything about how who owns the financial assets in the United States, it's not everybody. It's not like a 99%. It's most of these assets are owned by a very small number of people. Now everybody has a lot of people have 401ks, so they're exposed in that way. But the lion's share of the assets are held by the rich, if you want to call them that. And so if you're so he realizes that if you're going to pursue,
the definition of rich is one holding most of the assets.
Yeah, it definitely is a
that's the circular.
It's another circular. That's definitely a tautological point. I'm just trying to make a point about the distribution. It's a small. It's not a widely held thing. It's very much a narrow class
concentrated,
of people.
Right.
Yeah, it's a concentrated class.
We're looking at a few wallet addresses.
Right, the whales. So his point was that these policies were going to allocate more resources to these groups, and it was going to leave everybody else kind of holding the bag, redistributing wealth from the rich to the poor. How does that work? Why was he worried about that? Well, one of the ways it works is through interest rate policy. If you're rich people tend to have a lot of assets, financial assets. So they're going to do fine in a zero interest rate world because they're not living on a fixed income. They're they're not living off of CDs or bonds, or they're living on or a pension. They're holding stocks or holding real estate, and these things go up while interest rates go down. So there's an inverse relationship. Now, on the other side of that, if you're of humble means and say you're renting, or you don't have a lot of stocks in your portfolio, or don't have, say you have a CD with a few $1,000s on it, that's your savings. When interest rates fall to near zero, the return on your savings is now gone, or almost wiped out. You can look at bankrate.com and see what a CD pays. It's nothing. And when you factor in inflation, now you're really losing money, right? So you'd have to be investing your money in the stock market or in another way, real estate, and getting, better than 7% to be neutral in 2021. And most people who are of humble means don't fit that category. So when you look at these kind of inflationary periods, one of the things that people tend to miss is the redistribution of wealth, this allocative effect that happens. And we talk about this a lot in our past. We talked about in Austrian theory, we always would go back to Cantillon effects and the price effects, right? The way inflation enters the economy at a point, drives up certain prices first and then later others, and how that benefits some companies because they get the sales first, but some others might not till the end when the prices have already reset. And so they're losing money. So there's this reallocation of wealth across the holders of the asset, depending on where they're at in that chain. Yeah. So it's the same story. Yeah. We've talked about this before, but it's good to highlight the redistribution effect of this, and to say that it's not just like we're all waking up one day with a helicopter drop of,
It's good you say that, because, it's funny you say helicopter drop, because mentioning Ben Bernanke earlier, when we were studying, he was called helicopter Ben,
yeah,
because of his quantitative easing. What's funny is that Bernanke was called Helicopter Ben, and they would show little pictures,
cartoons and stuff,
of him dropping money. And yet, if you look at what was done, not in his under his command, but the actual distributing checks to every American
later on became
Never
that
used it.
became the helicopter. Yeah,
That's
right.
really the
Helicopter
ultimate
Powell.
helicopter effect of dropping out money. But what you're saying is there's this, and this is what people don't see. Everyone gets a check for $1,000, $2,000, $5,000. Doesn't really at this point, that's fine. But if you look at the distribution, the redistribution of wealth that's taking place on a grander scale, that's a pittance. It's a pittance. Getting that is a slap in the face, while the rest of the economy, the value, the assets, the wealth is being vacuumed, is being absorbed by these others.
Right.
And
Yeah. Well, I would say that I would have given this problem with the allocative effect or the Cantillon effect or whatever, the redistribution that's inherent in these policies, given that reality, a helicopter approach would have been better. You wouldn't have had as much of an allocative effect, because what they did was they just bought bonds and assets from the primary dealers. And this is later, we're going to get to this part later in the article. But essentially what QE is when they credit a Wall Street company with money they just created out of thin air, they buy an asset off their books. That Wall Street company now gets this amount of money in their account, which they can go spend on whatever they want. And the Fed now holds the asset. That essentially just gave the money directly to Wall Street and said, do it with it what thou will. Whereas a more helicopter approach, where it just gave everybody $1,000 or whatever, right? Just deposited an equal amount of money in everybody's account. Yeah, it would have created more price inflation because people would have gone out and spent it like we saw recently. But it wouldn't have had that redistribution effect of where some class of the economy is now getting billions of dollars in subsidies at the expense of all these other people, right? So I think this is all just to say Helicopter Ben would have been a better version to go with, in my mind.
Sure. And not just that, think of the moral hazard, what you just mentioned. This is what happens in real life. This is why so many people value cryptocurrency and blockchain and Bitcoin, when they really look at why are people valuing this tech? What service does it provide? Is it really doing anything for people? And most people understand it's the potential value that it brings to humanity or to world economies, to markets, is almost in many ways beyond measurable. It's able to remove moral hazard in ways that we don't have any models with which we can study. We don't have a model with which we can study a time where money or certain institutions were
it's not without moral hazard.
I mean, because look, you just gave a point where the Fed's like, you know what, we're deciding we're going to come in here and help shore up certain businesses. Well, now you not only do those people get the money first before others, but you choose. There's a choice made at which of these institutions are the ones that need to be and that there's a bias. You can't
think about this. Let's jump into that a little bit. So because this part right here kind of highlights one pathway where this moral hazard can go. So when the Fed purchases assets, they purchase them from the primary dealers. This is a 24 firm ultra exclusive club, JP Morgan, Goldman Sachs, those kinds of companies. They have access to the discount window, and they also have access to the Fed, right? Through selling, they can sell to the Fed. Well, when the Fed announces that they're going to purchase, some amount of treasuries or mortgage-backed securities, these financial firms now have the incentive to go buy those assets because they know they're going to turn around and resell them to the Fed at face value. So it encourages risk taking. It encourages It encourages them to speculate on which assets they want to buy that they're going to front, because they can front run the Fed, right? And so that's a whole pathway. And that you talk about insider trading with Martha Stewart or whatever. Imagine at this level.
I talk about it all the time.
Imagine at the level of 8 billion. You got that's a level of insider trading that doesn't even pop up on the radar of our legal system, because it's so beyond the kind of things that we're concerned with and that we have, that people even can understand.
It's like that joke. It's not funny, but what people say about a dictator, a despot, or a murderer. If you kill someone, they're a murderer. But if you
kill 100 million people, it's I can't remember what it's called. But you're right. It changes. It's no longer seen as a.
People can't look fathom at it. They can't fathom and look at the same picture, right? But yet it's still.
Well, let's see what else here. There's we've pretty much talked about a lot of this stuff, but what it all comes back down to is that this was going to, he was worried, Hoenig was worried that this quantitative easing would eventually lead to all kinds of new risks about whether it's redistributing of wealth across the economy or having an asset bubble or just general inflation. And that at the end of the day, he thought that it was going to put us in a situation where we'd be back to having to have double interest rates, kind of like in the 70s, to get us out of the inflation trap. And so that's where he said it was his duty to resist all this. And that's the main point.
I was going to say this too. Be ready for, this is kind of how historically how governments or states take over industries, right? Because it starts out where the Federal Reserve has to come in and bail out on their balance sheet and buy up certain asset classes, and now they own it. Now, at the moment, the Federal Reserve is a private company. It's a private
public. Yeah.
Well, they're not part of the government. They were commissioned as a private company,
but it's considered I got you.
It's special privileges, but it's not a constitutional, legislative, judicial, federal.
No.
It's a chosen amendment.
It's like a hybrid.
Hey, let's give you guys power. It was, you can track back when it was created, when certain people said, you're the company and we're going to give you power of printing money. But that's exactly what it was. It was an industry that was created politically and is a private industry that runs with its board and its own members and has its thing going. That owning the assets to these companies when there's a depression, recession, whenever they decide to pull the music stops, the musical chairs. Well, now when the state needs to help take care of everything and maybe even take over some of the banks, all those assets that were owned by the Federal Reserve are ready to just be turned over, because like you said, it's private, but it's also kind of part of the state too. It's become this,
it's a hybrid deal.
It's become this Marshall scissors.
Yeah, it's a mutant, it's a Frankenstein.
Yeah. So there's definitely a work together and a collaboration, right? So you don't have the power of the state without the Federal Reserve, because the Federal Reserve prints money. Private banking, fiat money, Federal Reserve has allowed for taxation through inflation and money printing at an extreme that humanity has never known in recorded history.
Right.
Never been an example of it. And so a lot of the markets and industries that we think we love and revere are really nothing more than industries that have been where people had to go just to chase the money to get food, wherever. You know.
It's a sort of a fixed outcome, I guess you could say, instead of a natural experiment.
And the beautiful thing about blockchain and crypto is the opportunity to see markets and economies. The excitement is, well, when you remove moral hazard, you remove bias, you take away certain elements of power, and you replace it with a transparent protocol where their inflation is standardized and everyone has access to it equally. It would actually have huge effects beyond just monetary stability. It would actually change.
Well, it changed social. I think it's actually really good because you're bringing this up, because it ties in with the very last point he makes. But it would also do a lot for our political, social, cultural struggles that we go through, because there's a lot of pain that's spread out across the entire population, and people might not always be able to put their finger on what it is, what's causing it, but they know that they're getting screwed and they can't put their finger on how, but they feel it. And they know it's not just them, it's widespread. So, and the more this happens, the more the ties that bind get broken down, right? And so I think if you're concerned about, stability and keeping the republic alive or keeping the democracy going and for the next 20, 50, 60, 80 years, then you could model one of the chief threats to that being straight through here, through monetary policy and inflation and interest rates, and how it divides the economy into winners and losers. And the winners are a very small number and the losers are a very large number, and how that is not a recipe for stability, right? So I want to highlight one little thing here before we wrap it up. The Fed's been through this before, right? We, not just the 70s where we had the rate hike to get out of the inflation then, but we went through this in 2018, 17. There was a concerted effort under Powell to raise rates, to reduce the bond, to sell bonds, sell assets, reduce the Fed's balance sheet, and to kind of reverse its QE programs, right? And the market did not like it. Bond markets didn't do well. Stock markets corrected. This was halted. They changed policy. They said, well, we can't continue this. We're going to destroy the economy, or we're going to cause a recession. So they halted the effort, and they pivoted back to inflating, back to easy money. And we've been in that moment since. So one of the takeaways from this is that I'm not so sure we're going to be able to do a 70 style or 81 style Paul Volcker double digit rate hike to snap us out of this, because of the fact that, one, the amount of debts that we have now in the government and in the private sector are so large that if you raise interest rates even to 3 to 4 or 5%, you're talking about debt service level that would make it impossible to meet the burden, and that the government would be bankrupt, the Treasury would be bankrupt, and we would default. I remember reading it would be like, if we had 4% or 5% rate of interest rates, Fed funds rate, that the debt service would every year would be the equivalent of fighting every single war the United States has ever fought all the way up to World War II every year. So just to give you an idea of how big the debt service would be. So that's not sustainable, and therefore it probably won't happen. I don't see that happening, and I don't see Paul Volcker style. I mean, this is my belief, but I don't see Paul Volcker style policies coming in that context, because I think you would just basically that'd be the end of the dollar. That'd be the end of the system, and people aren't going to do that voluntarily. So we're probably going to see more of the same, more easy money policies. And that means that you can expect that labor productivity will not be met by the same kind of real medium weekly earnings gains and wages and salaries that we saw in the past. And you see all this in this paragraph kind of summarizes the differences of how the older period in 92 to 2000 versus this period 2010 to 2018, the easy money period, and how the 90s had such greater rates of wage growth and salary growth, as well as real domestic GDP growth, and versus today in this period of easy money, that everything's been reduced. Wage growth has been reduced, GDP has been reduced. And so the idea is that the outlook with the easy money policies is not as good as what a stronger dollar policy can do.
But at this point,
yeah, go ahead.
But at this point, like you said, I feel that the people who are working in these industries are very well aware. And you look at CBDCs, and we'll talk about how where we're at now and being at the end of the road, the positions that were taken in the 70s aren't practical, and people, banking institutions are looking at new solutions to move forward.
Yeah.
And we're already seeing how blockchain through CBDCs, central bank digital currencies, are being used to do some money market magic mechanics that no one ever in the past thought would be possible. It would be a joke to think about negative interest rates,
right,
in a manner where if people didn't spend their stimulus check within 50 days,
they got a haircut. Yeah,
it would be gone from their wallet. And so that's why education is important, understanding how this technology works, because that would be the wrong direction to go.
Indeed.
From my perspective, how I feel, it's missing the boat and the value proposition of blockchain and crypto to move away from centralized ledgers, which is what we already have. And to the purpose is to go to the those decentralized protocols, and that offer a solution that removes that moral hazard,
right,
and that human element.
And to me, that final point of that the moral hazard and the human element, the way that the systems can be bent to benefit a handful of people at the expense of the whole society, this is probably, in my mind, what led to Trump, what led to 2016, why things have so shifted gears politically, why the turmoil and the anger is so high, so great. And it's because of the fact that the many people all throughout society feel like they're getting screwed. They don't know how, they don't know why, they just know it. And so they're reacting to it. And and they react according to their knowledge, what they understand. And as long as that's the case, the turmoil, I think, will continue. And if we see negative interest rates, that's going to even double down on it even more, on this phenomenon of a handful of people benefiting at the expense of the rest. And I want to wrap it up on one little topic. This is something we love talking about. It's kind of it's a puzzle to me. Why is it and how is it that something so clear? I mean, Hoenig made these arguments in 2010, and it was pretty obvious, talking about asset price inflation and redistribution of wealth and all that. So how is it these insights fell on deaf ears, and that we just doubled down on a policy that even by their own studies suggested would have very limited effects? I'm talking about QE. They said it would move the needle on unemployment, not even 1%. So very minimal potential benefits. But we saw that clearly there's great risks, and with inflation and destabilizing asset prices and bubbles, and then the redistribution of wealth and what that can mean for politics and our culture. So if these risks are so large, the costs are so potentially so large, benefits so muted, so limited, why would we choose that policy? How did that policy get chosen? What system would yield that outcome? And I think one of the ways to understand that, because it seems counterintuitive, like, why wouldn't you just choose the policy that was going to have the biggest net expected value, right? Instead of this thing that seemed like a long shot. And I think one way to understand that question is by looking at what's called public choice theory, and by considering what role this dispersed cost, condensed benefit model, how that plays to kind of give these results. And let's unpack that. So in public choice theory, they analyze politics. The idea is to take economic tools and look at political decision making under the same lens, and try to figure out what's happening, what are the interests that are being served, and all that. And one of the things to kind of consider is that anytime you have a policy that delivers massive amounts of concentrated benefit to some small number of people, you can clearly see they have an incentive to make that happen, right? They're going to spend millions or billions or however much lobbying for it because they get a direct benefit, and it's massive. And on the flip side, if usually these policies have very limited costs, but because they're dispersed across large numbers of people, so they're not felt greatly by any one person, but it's a negative that everybody faces, right? Or many people face. And so if it's spread out across such a large number of people, and especially if it's in the future, in the distant future, it's easy to discount those negatives, and it's difficult to get people to want to organize. Say, like the great example in economics is the sugar quota. Is sugar tax. It costs millions of dollars. It's millions of dollars revenue for the sugar companies, but it probably costs you and me and our family like $1 a year, maybe $2 or something. Because I mean, how often do you buy a bag of sugar? Maybe it's $5. Let's just make it $5 a year, on the high end of what
that $5 is spread out over purchases. So
yeah, it's not all at once. It's going to be spread out across the year, right? And that's just what you're going to pay an extra because of this quota. Well, yeah, that $5. If someone says, "Hey, you can go to this meeting. I'm holding it in my house down the street. We're going to organize. We're going to write some letters to our congressman. We're going to make some phone calls. We're going to see if we can get some people on the council running. We're going to see if we can get a congressman to run. And we're going to really push forward to get this taken care of and get this $5 back in your pocket." Well, it would seem ridiculous because all this time and energy to save $5 doesn't make sense.
It actually would be.
It would be ridiculous.
It would be. They make it to where the time value, the opportunity cost of time and life makes it to where men and women are not. There is no rational incentive. You're not rationally incentivized.
It'd be irrational to incentive to organize through that. It'd be like walking past $1 and pick up a penny.
Right.
Essentially, right. So for that reason, the people who have the most to lose are not incentivized to do anything about it because it's such a small cost. But the people who have the most to gain are very much incentivized because there's very few of them and the gains are great. Right. So because of this dynamic, this condensed condensed benefit, dispersed cost dynamic, it's often the case that politics yields outcomes that are really good for a small number of people, but really bad for the majority. And you get locked into that outcome and you wonder why. Why is it? Well, it's because of this. It's because of that. It's not because politicians are stupid or evil. It's because they're following the incentives that are ahead of them, in front of them.
They're human. They're men and women, just like you.
And there's no incentive to go to bat for a group of people who don't organize. You go to bat for the people who do organize, people who are there writing campaign checks so you can get reelected. People who
And you go to
protest.
bat for your family. And
Well, you go back. I'm talking about politically, like in your
right.
in the policy sphere. Yeah, but
But
certainly go to bat for your family.
But I mean, if you're this brings up a similar point to the same mechanism. When people are in a position of power in this political choice theory, you're going to make choices that put food on the table for your family,
you and yours,
yourself. Everyone
right.
who works in politics is getting it's their livelihood. It's their, whether they get benefits and privileges and free trips or meals or plus their salaries, and that's how they survive. So when you are in a position of authority and you have only 4-year window to make decisions that are going to benefit you and your family to the max, you're going to make those choices that are going to maximize that power that you have during that window. And
which means respond to the interest groups that are pressuring you.
Right. And it's not because you're a bad person. It's the way that it's the way that the machine, the mechanism, the institution, that it's the game. It's the way that the game was designed. So what's beautiful about blockchain and crypto is we see ways that the game theory, that the incentives can be changed so that long term we can have more harmonious relations with each other, that we're not pitted against each other in certain ways.
Well, it's the Buckminster Fuller dictum that you don't change society by, well, you could potentially, but the path to changing society is not always found through just directly trying to change it, but rather building something different. Right. And that makes the other thing that you didn't like obsolete or a moot point. Right. And I think that's the path. It's like, we're not going to vote our way out of this. You're not going to run the right. You're not going to join some movement and get somebody elected that's going to all of a sudden make this work. Politics is going to deliver the outcomes that it's always delivered. And you shouldn't probably expect too much more out of it. So if you really want to see the world change and for the better, you got to build something different outside of that, right? Move your focus outside of that, because that's probably a losing game because of this dynamic about the benefits and the costs. It's going to make it hard for society as a whole to move forward in a positive direction through a political means. But that doesn't mean we can't move forward in a positive direction. We just have to be more creative. How do we reinvent or renovate or innovate institutions such that we don't really need to turn to the state? We've got our own mechanism. I think that's the path forward.
I think that's a good way to we covered a lot on this video. And we'll continue to cover these topics. In fact, we have another video that we'll be making pretty soon to compare the world monetary supply to blockchain and crypto, because we feel that many narratives that are coming out politically are that blockchain or crypto are posing some kind of threat to certain economies, national stability. And it's laughable. It's a joke. And that whole notion needs to be squashed with a little bit of knowledge and education, because the reality is that the flaws, the problems that are being pointed to here and that have been known for some time in the modern commercial banking system are so great and on such a large scale that we're talking trillions of dollars, hundreds of billions. The size of the whole blockchain crypto market cap is a needle. It's just a tiny little drop compared to, and it makes me think when you said earlier, why would people do these easy money policies with negligible results and labor and other things? Well, versus tightening up and strengthening the dollar, I feel, and this could be going back, there's that old Time magazine that talks about, I wouldn't say Bitcoin directly, but it like 20 or 30 years ago alluded to a digital currency. It seems that the direction going to the purpose would be to move towards a CBDC, to have a more seamless transition into a CBD style digital bank, instead of having this quick, painful, tough, let's fix things up and clean things up. Instead, let's just patch it along as much as we can until we can hop over into this new thing.
And then we're going to do negative interest rates.
And then we're going to do and then by that time, people's heads will be so turned around because they won't have any time to look at how the whole system was a Ponzi scheme and was broken in the first place. Now they're rushed over learning how to operate a new digital wallet with the free $1,000 credit from, so
that's a potential future for sure. And we're going to cover it. So stick with us. Like, subscribe, comment, thumbs up, whatever you want to do. We'll love to talk to you and add to, hear your perspectives, add to the conversation. There's parts of this we have not thought about or caught. So by all means, point us in the right direction if there's something we've missed. Otherwise, look out for some new videos. They're coming. We're making them. We're going to start 2022 off with a bang. So see you then.
Until the next time, have a beautiful day, y'all, and namaste.